right, guys. So, Fed, FOMC rate decision and speech today. The decision's going to come out in about 7 minutes. We're going to listen to CNBC, The Exchange, with a Fed official, El Ararian, whatever his name is. I never get it right. We're going to listen to his take. Then we're going to look at the Fed rate decision. Then we're going to probably dig through the notes, which I'm new at, but I'm going to try and get it going. If you guys could hit the like, that would be wonderful. And then after that, we'll talk for a while. If we have some time, maybe we'll talk about U.S. economic data before the actual speech from Jerome Powell. And if we cover that now, then we'll just probably skip it in the market recap. So anyway, let's listen to El Arjarian and see what his take is.
Welcome back. The Fed is poised to hold rates steady today, and our next guest says that move could be the first step in a policy mistake that could spoil the chances of a soft landing. But as of now, he sees a 50% chance of the market getting out relatively unscathed. Joining me now is Mohamed El-Erian, Allianz Chief Economic Advisor and former PIMCO CEO. Mohamed, great to see you. Welcome.
Thanks for having me, Kelly.
Do you think they should cut today?
I do. I'm in the camp that they should cut today because the economy is weakening much faster than they realize.
What do you point to for that?
So first, I listen very carefully to what the companies are saying, and whether it's Starbucks, McDonald's, PepsiCo, you can go down the list. They're all pointing to softening demand and a loss of pricing power. Secondly, I look at the cracks in the labor market, and I worry about that. And then I also look at what's happening to the lower segment of the consumer, and there's real pain there already. So when you put these three things together, there is a risk that they build on each other, and next thing you know, you are very close to a recession.
Yeah, well, you know how I know we're close is because I'm finally starting to feel bullish. So that must be a sign, because I have to tell you, I've been waiting. The leading indicators have been inverted for like 2 years, right? We know that the classic signs have all been pointing towards a slowdown, ISM manufacturing and so forth. But then jobless claims are holding in there. Yesterday, I mean, the number of job openings rebounding the way that it did, consumer confidence, okay, you could quibble with some components of it, but overall it's improving. I don't know. And yet Michael Dardis says he's in your camp and says, kiss the soft landing goodbye. A harder one is coming.
So I'm not kissing it goodbye. I'm saying a 50% chance. Look, we are totally dependent on the labor market. Most households have run down their pandemic savings.
I just want to say it's a really easy move to say 50%. It's really easy.
Too many have maxed out their credit cards. So if we lose labor income,
this is all true. He's right about the fact that people have maxed out at cards and that there's defaults in the auto sector and other sectors of the credit economy. But I would argue that it's the bottom 1/3. It's the poorest of Americans that have been crushed by inflation. The ones who own assets, the upper 2/3 almost, 60% plus, have gained wealth since the pandemic. So again, I think the 2/3 outweigh the one.
Then we are in trouble. So yes, the labor market becomes absolutely critical, but there are no other spare tires right now in this economy.
But I wonder if the labor market looks fine, right? I mean, the best leading indicator we have, jobless claims, it's pretty tame. Now, it's not going to break out until we're on the precipice of that slowdown. Yes, the unemployment rate has risen, but we also have some structural things going on with this immigration surge. So, if it keeps rising, okay, grant that, but I respect Claudia Sahm for saying in defiance of her own indicator that maybe it's different this time because of some of those factors.
And it could be, it's a balance of risk, ultimately. So on the inflation side, we've made progress, and today's statement will welcome further progress in reducing inflation. I think the inflation rate will settle between 2.5% and 3%, where most people would view this as price stability. Most would view it as consistent with anchored inflation expectations. So that side of the mandate, if you don't over-obsess with just a single number, 2%, is fine. It's the other side of the mandate that's becoming more risky. And you'll see this again today. I suspect Chair Powell in his press conference will seek a much more balanced risk and weighing up the risk of the employment mandate being threatened.
Yeah. No, I wish we could know Friday's report today. I mean, that's always the case with Fed meetings, but especially right now. Is it possible that the immigration surge is throwing a wrench into these figures? In other words, that the reason why the unemployment rate is rising is just because we're not absorbing all of those new workers and the potential GDP is higher than we realize?
No, it could be. And that surge has been a positive supply shock. There's a question mark as to how long it's going to last. Some economists think we've had the best of it. But it has been, this has been an exceptional economy. U.S. economic exceptionalism has been incredible. We got numbers that Germany slipped into a negative GDP growth recently again. The U.S. has been really the star performer, and we don't want to ruin this.
I completely agree. And I'm sure you could say, look, a couple of cuts on the margin probably would do the most to support the continued expansion. So you would say if they don't cut by, September, then that would definitely be a mistake.
Yeah, whether they cut in July or September won't make that big a difference. The problem is this is a highly data-dependent Fed. It's overly data-dependent. And high-frequency data, as you know, Kelly, is noisy. We saw today with the Eurozone inflation number going.
He's 100% right about that. The Fed is backwards looking, and that most of the data they focus on is noisy, and some of it deliberately so.
Going back up, they could get a bad inflation print. And if they are overly data dependent, then next thing we know, they don't cut in September, and then they'll look at November. And by that time, we have the lagged effects of the.
I disagree. There's no effing way that the Fed waits that long. I'm sorry, that's just not possible. Let me see if I can find the. Where's my CME Fed Watch tool? Oh, here it is. 1 second here. I just want to look at what our odds are. I'm sorry to interrupt this again, but I think this is important. We need to look and see what the Fed Watch tool is saying right now about the September rate cut, because he just said, hey, if they don't, so we need to know, will they? I don't know. There's 100% chance that they'll cut 25 pretty much, and then for 50 bips, it's 10%. So I'm going to say we definitely have a cut in September. I don't even think that's a question.
Interest rates. You have the higher for longer, and you have already the weakening structure, and then you really start to worry. That's why, look, I would rather they cut today. I know they're not going to cut today. If they cut in September, it's not in the end of the world. But if they get derailed from September, then the 50% chance of a soft landing goes down quite a bit.
Yeah, and you could see that maybe a couple. So if they're not data dependent, what are they? How else do you make a decision?
So you should be forward-looking as well. You never drive a car looking just at the rearview mirror. You also look at the road ahead. And you have quite a bit of indicators suggesting what the road ahead looks like. They got burned badly in 2021 when they did take a look forward and ended up with this transitory inflation narrative that really hurt them. So they've been very cautious, but they've become overly data dependent. So what would be good for...
I actually think the Fed has been waiting to lower rates for a deliberate reason, and I'll talk about that in a sec.
The U.S. economy is for them to be more balanced between backward-looking and forward-looking indicators.
All right, it's a tricky thing because even the people looking at that are having two different conclusions right now. Mohammed, thanks for being clear in where you stand. It's good to see you this afternoon. Appreciate it.
All right, I actually like Mohammed. He can be wrong a decent amount of the time, especially on timing. But I do want to talk to something that he just said. So I'm just going to pop over here on X, zoom in just a hair. That might be too much. It's too big of a face there. All right, so I hate the way my scroll bar works. I need to get a better mouse now that I'm running a Mac. It had some good points, but that's not what I want to talk about. Let me see if I can find it. This is what happens when you have too many things. I think I have it under a bookmark. So bear with me one more second here, guys. We've got, let me see if the Fed rate decision came out. My bad. Let me see here. What are we at? Nope, nothing yet, but it's time. It's 1 o'clock. If you guys start to see something about the Fed rate decision, please let me know. Conference call, long run, PDF minutes. I don't think that's it. Yeah, so let me know if you guys see that. All right, where was I? Okay, over here. U.S. economy. And zoom in. And not that one. Not that one. This one right here. So I just made a little note. I said, I think that was deliberate. So they're saying like, hey, the Fed didn't cut yet. And it's crazy that parts of Europe are cutting. European Union, Canada, all this stuff, like we're seeing cuts, right? We're seeing cuts across multiple countries around the world. I actually think there's a reason for that. I think we've been trying to put pressure. No rate cut? Yeah, not surprising at all. Okay, so that's boring news now. Now we got a 28-minute wait for the speech. But yeah, so I want to finish my thought here. So I think it's deliberate. I actually think we've been doing this to put pressure on China and hurt the yuan. I also think we've been doing this so that countries around the world say, wow, the U.S. Fed is holding on longer than everybody else. They're definitely the cleanest shirt in the dirty laundry, which everybody kind of knows, but I think they want to accentuate that pressure and let them know that it's happening. So I think that's one of the key reasons we haven't cut. Maybe I'm wrong. I doubt it. I think I'm right. But I think that that's something we could see now, or that we have seen. Now, I wanted to talk. Tom Lee said the most likely path post FOMC is rally in equities led by small caps. And I 100% agree with that. We'll keep an eye on what's going on here. We did have a little bit of a market dip. I think the market is waiting to digest whatever wording we see from good old Jerome. And we will be listening to that. But it's sitting and waiting. It wants to know, is Jerome going to say that things appear to be, somewhat declining, and that the data is starting to indicate, and that we're going to have a closer reevaluation coming up here soon. Just anything that leans towards a September cut. And maybe he'll be more straightforward than that. I've got to say he won't, because Powell loves to surprise people, or loves to leave them hanging until the exact, absolute last minute. And they don't have leaks in this Fed. They used to back in the day. There's been a number of Feds where they would leak. Bernanke was one. I can't even remember the names of some of the older ones. It's been so many years. But again, there's been leaks. Yellen too, amongst others. So we don't see that from this Fed. They like to be dramatic. But I do agree with Tom Lee. I think that what we're going to see is that the stock market rallies into this, because we're going to have a narrative of, okay, rates are getting better, which should help auto sales. Rates are getting better, which should help real estate. And when we're looking at these subjects, these are a very big deal. Let me actually go back here. I'm going to turn some of this back. I'm going to dial this back, and I'm going to do recent this week, because I want to go back a few days. There's stuff we need to understand, okay? There's stuff you need to understand. I think I already understand it, hopefully. But pending home sales is one of these things, right? So we're getting back to like a level range here. We're getting back to a level range, but we've seen a massive disparity, massive percentage change drop in home sales for a long period of time. So it's looking for relief. It's looking for relief. These want to go up. And actually, it's not even that I'm looking for. Let me see. Home. I'll just look for home. United States home sales, pending home sales, existing homes is a better representation. Let me go over to here. So as you can see, we're at levels in existing home sales. If I go back like the last 10 years, we're at the absolute lows. If I go back even further than that, you can see all the way back to like 2010 at the depths. We're at like 2008, 2010 at the depths when things were falling apart from the GFC, and all the entire housing market was unraveling. We're at that already, okay? So what's important about this is that if we've already seen a huge trough that's lasted over a year and a half, the next oscillating path for this move isn't down. It's not down. This isn't how markets work. When everybody's starting to get scared about the market collapsing, that's about the time you're going to see a melt up. And people are talking about like the everything bubble. Sure. Well, you know what it needs to happen? It needs to be a bubble. It hasn't been a bubble for the last year and a half. If you look at these indices, they've recovered. And then some of them, especially if you're looking at the Mag 7, have done really well, right? They're cash rich. They're just money printers. And then they have business overseas. Sometimes they benefit from currency exchange. There's just a lot. Yeah, there hasn't been a rate cut. It's unchanged, just so everybody knows. I'm not focused on it too much right now because that's probably the least of the news. I think the real news comes from the speech. I'm just trying to preface what I think is going to happen in the markets after this speech. I think we're going to see some loosening verbiage from Powell, looser than he's been. And he's kind of waffled back and forth, but the last couple of speeches, maybe even for months and quarters, has, or I should say at least a quarter, has been pretty like, we're not really looking at it right now. We're still looking at data. We don't have enough. But I think that changes all today. And again, real estate, auto, all these sectors have been crushed. Small business has been crushed because they can't refinance these heavy rates and these really, they got some good deals on loans for a period of time, and then some of this is running out, right? And so they need to roll debt over. And when we're looking at an environment, yeah, I think we're going to see a dovish Powell, Roy. But when you look at an environment where the market is just destroyed. I can't remember my thought. I lost my thought. We'll move on. But yeah, so the gist is the existing home sales sector crushed. Auto sector crushed. Auto is so bad right now. Repossessions are through the roof. If you guys don't follow like used car sales guy, I think is what it's called on X, he gives a bunch of really good information that shows you how much how devastated that sector is. And one good thing that I want to point out that we don't talk about too much is years ago, when everybody talks about like 2008, when they talk about 2000, when you go back to the Depression, all these other times where people love to do comparisons about the Fed raising rates, right? There's a couple of things they don't factor in. A, they don't factor in what happened in 2008, where we printed $850 billion. I know that sounds like a Tuesday now, but that was the most epic amount of money printing that in the history of this country and the world at that time. And it was a huge percentage. And so, again, it was like pandemic-like, right? For the response to it, it was crazy. And so we turned on the money printer, and in the act of doing that, we have made it to where we can't turn it off. We're paying $1.17 trillion potentially this year in just interest on our debt. And we need interest rates to fall if inflation isn't powerful, okay? We need that. The U.S. needs that because if we don't have that, we can't even service our debts. So we need to expand the money supply and global liquidity. And I want to show you something too. I think I have this over here on X. It's in regard to China and global liquidity. I've actually got a couple of references to it, I believe, that I bookmarked earlier in the day. Let me see. Yeah, right over here. Or maybe not. I don't know. Bookmarks on X sucks so much. I hate them. Let's see if I can find it. I don't know why I can't find it. So essentially, I'll try and find it a little bit later here, maybe during the speech. But from Cross-Border Capital and from a couple of other sources that measured liquidity in different ways, they said that China is printing. And as you know from my take on China, they have to too. They're like 2.5x the indebtedness for debt to GDP versus what the United States has. And so they're devastated right now. There are parts of that country, big cities with millions of people, even over like 10 million people, that have some housing prices that have fell by 70%. You put yourself in those people's shoes. This was the majority. People in China, they don't invest in the stock market, okay? They don't invest in the stock market because the stock market has fucked them for well over a decade. So if you can't invest in that and make money, you use real estate. And I think it was like 75% of new home sales like a year and a half ago in China were for second, third, and fourth homes. Think about that. So almost the entirety of the market, the vast majority of it, 3/4 of it, is just people speculating. Does that sound familiar? Does that sound like 2008? So anyway, the money printer is going burr in China. I'm going to see if I can find this real quick. China. You know what? We should use Grok. I need to teach people to use Grok anyway. China money printing chart. Let's see. We'll see if this finds anything. I don't know. Grok's pretty handy though. If you guys don't use them, or if you don't pay for the premium service, I suggest you do. It's really pretty great. Let me see if anybody's got a good chart here. M2 money supply, year over year, record low. Nah, that's not helpful. Damn it. It's usually so good. Ooh, let me see. Manufacturing. So they're showing where they're printing money on. That's kind of interesting. This is quite literally the money chart on where China is trying to grow. You know, this is kind of interesting. I haven't seen this one. So since 2021, they've been lowering real estate drastically. I mean, it's a devastated market. And then they've been pumping into manufacturing, mostly EVs. That's actually kind of a fascinating chart. I'm going to save that one and bookmark it and then see if it'll actually take. Should get this little ad thing down here. There you go. That's what I'm talking about. You guys can't see that, I guess. But I can. All right, we're bookmarking that. I'm going to go back through my other bookmarks. I'm just going to look under all in case it, you know what, I'll just go through my profile. This might be a little laborsome, but there's some points I absolutely want to make here. And you know what, let's look real quickly. We'll do this first. We'll look at Amit's post. So Amit said, breaking, private businesses in the U.S. added 122,000 workers to their payrolls in July. This is the least hiring in 6 months. The street wanted 150,000 jobs. Okay, he said we get more data on Friday in regard to jobs. So let's just look at some of that. Excuse me. So job openings. Let's look at this. Let's go back because stats are great. Graphs are better. So I would actually argue right now that we're in a normalization of this trend. If we look across here and we draw this up, we're maybe a little bit underneath of it, but you always oscillate, right? Like we fell off a cliff, we rocketed to the moon. It makes sense that maybe we'd hit the 7,100 level or something like that from an oscillation standpoint, which is like math across everything, and then try and go higher or drop if I'm wrong about the economy, but I don't think that's what's happening. So that first, that's what he's talking about in regard to this job openings. It says However, yesterday the JOLTS number showed we had almost 200,000 more jobs available than expected with the 8-1. You know what? Maybe that's the other one. Let me see. Let me go back. That is the JOLTS job opening. So again, we had more than expected. So I got the wrong one here. He's talking about ADP employment change. So let me go here, pull that up. And again, this is such... even if we look at, this is almost dead. I just want to say that this is it's like a flat line. So I don't know how much signal we're getting from ADP employment. It's wild. If you look here at what happened during the pandemic, if we go out a ways, like look at this, look at all the oscillations up and down. This is the most flat line data I've ever seen. It's slightly negative. Again, July was negative 21,000, but it's just flatlined. So I think what really matters is what the direction of the economy and what people take out of today's Fed meeting. But I think the primary message, I think the message the markets gets right now is in phase. Tesla, housing sector, all these areas are ready to boom. We still have the AI narrative to back us up. We still have the Bitcoin narrative to back us up, where that cycle normally doesn't end for 9 to 12 months, at least from where we're at right now, 9 to 15, honestly. So we've still got all these narratives, global liquidity. We've got all these narratives that are showing that we should still have a run. And the most likely path from everything I've seen is up and not down, unless people think we're too late. I don't think they think we're there yet. Some might, but I think that the gamblers, the people that are going to invest and bet, I think that they are ready to let this thing run. And also, I just wanted to say, NVIDIA did lose $2.6 trillion, or I'm sorry, not NVIDIA, but the Mag 7 over a short period of time. So, and then today we have NVIDIA up 11.55. These charts look beautiful. I'm actually going to pull this. Well, I'm trying to think if I want to pull those up or not. Let's just we'll look at the heat map. We can always go into individuals from here. But look at this. Look at this sector here and how strong it is. And actually, let's look at the indices and see who's winning today. S&P. 1.66. And again, guys, we got about 14 minutes until Powell's speech. So we're up 1.66 on the S&P. That's probably like all Mag 7. Oh, but look at the NASDAQ, where we have a lot more tech heavy, 2.73. So definitely leading the pack so far. And then so far, the rut isn't doing that well. But again, look at this run. Look at this base that we've established here. I think that after we get this rebound in tech, after we get the hey, we're probably going to lower speech today from the Fed and Jerome Powell, I think that then we see the Russell take back over again. That's my take. That's what I think is going to come up. And that's where I've got my money put, as you guys know. All right, let's go back. I want to look at the heat map one more time. Let's see what else. So Amazon's doing great. Like so many different companies. Look at Tesla doing wonderful. PayPal, again, today doing well. SoFi doing well. I would actually argue, let's just look here. We'll roll through a few of these. So we want to get above the 200 moving average on the weekly time frame. That's the big thing. It's also a fib level right here. So we really want to see with Tesla, we want to see like 234. If we get 234 and turn that into a support zone, it will be the first time we've launched above this and not just catastrophically fallen and instead started to break back of it in a very long time, like since last year. Let's look at PayPal. Again, Great quarter from this company, 3.33%. I actually think we could start to launch. I think we could see if the Fed meeting does go well, and I'm right about that. Let's hope. The 68.50, 69 range. 69, how poetic would that be? I could see that happening. Let's go to SoFi. SoFi is so ready to break out. I don't know what to say here. Like, this is so ready. Let's just expand this out here. Look at this. Look at this. The trend line going all the way back to November of 2021. So we're looking at, what, three-ish years? Oh, almost 3 years. And then again, the high, what was the high? How many days ago was that? Let's see here. Almost 1,300. So again, just one of these companies that got devastated. So we're breaking out of a trend that's almost 3 years old. And we've got, almost 3.5-ish plus years since we were at the all-time high for the stock. And we're in an environment where this is a bank and we're lowering rates, which should be conducive to lending. Now, I don't know. I don't love banks. I do own some of this. I've got less than 1%. I don't love banks. I love fintech more. So PayPal, Square. Speaking of Square, this one is pretty depressed. I don't like the options chain on this. I looked at it today because somebody else was talking about how they like Square better as a play. I actually do like Square a lot, but it is a $38 billion company. Again, I think it could run, it could double, but I don't see a good asymmetric bet from what I'm seeing underneath the options contracts. So I pass. Let's see how everything's doing. Let's just go through the list. We got Palantir up 2.62, looking okay. I still think that one rolls over. ARCG today up 1.31. We really need to get up to the 31, 6, really 30. If we can get above 33, 34, if we can get above that, it's just off to the races on this one. That's a decent stint from here. But if we do that, I think it's an easy run between like 46 and 74, believe it or not. And that could happen over a period of like a year. But that's some good stuff there. Let's look at Bitcoin. Bitcoin up 0.3%, nothing crazy. But you know what I love, and this is on the weekly time frame. Look at how well we're respecting this line right here, this fib level. It is beautiful. This green line is the fib level, and then we're pressing up against peak volumes, which is shown as red here. I think we're going to roll up and we're going to break higher. I think the Trump pump hasn't even started. Let me look through comments because I have not been focused on that. We got 10 minutes until the Fed talks here, and let me just make sure I've got the best source for that video. I'm going to pull that up real quick. So if you guys just hang out 1 second, please. Talk amongst yourselves. Say hi to each other. All right, real quick here. Live. Sorry, I should have had this pulled up. All right, I've got a Bloomberg television source. We're going to take that as the one we want.
And the statement, largely unchanged as well. Just
1 second. I'm going to mute it, though, because I don't want to hear it. All right, and this is it. So we'll be watching this here in a second. All right, and then we have what? We got 10 minutes? All right, cool. Let's see what else. Oh, yeah, I should finish Amit's thoughts here. I should give this man a chance. Sorry, I'm all over the place today. However, yesterday the JOLTS number showed we had almost 200,000 more jobs available than expected with the 8.184. So which is it? I don't know. I don't think, again, I showed you how flatlined the ADP data was. If I'm right about my thesis, this is going to do really well. So, and Amit will have his answer in a little bit. Let me just see if there's anything else. Again, I was really hoping. Oh, I wanted to talk to this real quick while we're here, while we're waiting. I said I would only throw in the credit card companies for now. Fintech still has room to grow. So Doge Designer, he loves Elon Musk. He loves everything Elon Musk, and he's a good dude. He posted X payments later this year. That X is going to be like, God, I hope that isn't Disneyland. And the others are just like the House of Doom. So I don't think that's true. I actually think, now the credit cards, I've been talking about this a lot lately, the MasterCards, the Visas, the American Expresses, all these credit card companies are worthless. You pay a 2 to 3% fee merchants have to pay to be able to have people pay their bills. Nobody liked this one. I'm going to put this under U.S. economy because I think it's important. But this is a huge deal because there's no need for that. In the age of crypto, there's no need for that. Companies like PayPal are going to are offering PYUSD. They're offering stable coins that can act as the dollar. And we know the government, at least the Trump administration, is likely to push for dollar utilization in stable coins. They love that. They love the idea of a digital dollar that isn't a CBDC. That's the message being pushed by Republicans. I would love to say Democrats, but they're not quite there. Some of them are. There's some smart, really smart Democrats. They're just the minority right now, unfortunately. Let me see what else I have here. That was not supposed to be there. Oh, this is a bunch of crap. Let me see. So many things. I post a lot. I give a lot of opinions, guys. A lot of opinions here. Let me see here. Maybe I won't find what I'm looking for. Doesn't look like it. So what we might do, if I can't find what I'm looking for, or I'll look for it on another screen, we're going to go ahead. And again, Venezuela, it breaks my heart with what's happening there. All I could say is what Michael Saylor says here: fix the money, fix the world. If governments are forced to be our servants because they're not our masters through printing all of our money away, then we should have a much better world. And I hope that can be one of the downfalls of Maduro in Venezuela, so that those people can have freedom, because they deserve it. Some of them are dying for it. I haven't posted the videos of that, but it's brutal. All right, so let me just get, I'm going to pump this up. We're going to listen to him talk for a second, and I'm going to fast forward.
Some incremental changes. So the focus on the news.
Pin down and nail down that balance of risks argument, because that's what the chair had said in front of Congress. So I think this was the right incremental.
Again, we have about 7 minutes till Jerome.
Move. I think the Fed feels that it's in a sweet spot right now, that the data is moving in its direction, so it's getting closer. It just needs a little bit more, and then that confidence, that nebulous confidence, may be there. So this is what we were expecting. We weren't expecting a big lean in either direction from the statement.
The market, as you know, Mike, has been looking for September and a baby step towards that. You and the team have been looking for December. What separates you at the moment, Michael, the data that backs up your view? What separates you from the rest of the street at the moment?
Well, I'd say we have less concern about downside risk to the economy. We certainly are watching for it and looking out for that we may be wrong on this view. But the economy grew at a pretty solid pace in the second quarter. And yes, things are moderating and cooling, but I still think that there's a lot of resilience to both the economy and labor markets. And we'll see. Maybe there's a little unevenness in this inflation story. But certainly a September cut has moved a lot closer to our baseline. So yeah, we're still in December, but we've got 2 employment reports and 2 inflation reports between now and then. Further progress in those 2 variables, a little bit weaker employment, kind of repeats of what we just saw in June inflation, that could easily put a cut on the table in September.
All right, we're actually going to take a pause from him real quick. I want to read this. So this is the note. We've got about 5 minutes, so let's see how far I can get. Recent indicators suggest that the economic activity has continued to expand at a solid pace. Job gains have moderated, and the unemployment rate has moved up but remains low. Inflation has eased over the past year but remains somewhat elevated. In recent months, there's been some further progress towards the committee's 2% inflation objective. That's interesting. They're saying that there's progress. The committee seeks to achieve maximum employment inflation at the rate of 2% over the long run. This is over years, guys, not today, but they're going to get there fast. The committee judges that the risks in achieving its employment and inflation goals continue to move into better balance. That's progress. The economic outlook is uncertain, and the committee is sensitive to the risks of both sides of its dual mandate. So now they're saying, hey, guys, we're looking at both. So we're leaning over to the whoa, is the economy slowing too much? Is inflation starting to turn into deflation? So this is good stuff. In support of its goals, the committee decided to maintain the target rate. Okay, whatever. And considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, the balance risk, blah, 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 blah. The committee does not expect it will be appropriate to reduce the target rate until it has gained greater confidence. There's a lot of days between July and the September rate cut, okay? A lot of days. So even this wording, don't let it scare you off. There's literally, August, September. There's 2 months of data to be able to get us to that point. So there's a lot of data that can change their mind and validate the case. And I think they're just they're wording it this way, but that's what it means. In addition, the committee will continue reducing its holdings of Treasury securities and agency debt and agency market-backed securities. The committee is strongly committed to returning to its inflation. So they're still unloading off the balance sheet. I think that's going to stop in September. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook. The committee will be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. So this is interesting. They're starting to worry about the other side more, or at least voice that. The committee's assessment will take into account a wide range of information, including readings on labor market conditions, inflation pressures, inflation expectations, and financial and international developments. Financial and international developments. Fascinating. We still got about 3 minutes. I'm going to keep reading. Decisions regarding monetary policy information. And again, this is kind of my first time reading these out loud myself, so this is a new process for me, but I'll be doing this more as time goes on. The Federal Reserve has made the following decisions to implement the monetary policy state announced by the Federal Open Market Committee in its statement on July 31st. The Board of Governors voted, whatever, this is just boring shit. As a part of the policy decision to direct and open, effective August 1st, the Federal Open Market Committee directs the desk to undertake an open market operations as necessary to maintain the federal funds rate in a target range, so keep it the same. Conduct standing overnight repurchase agreement operations with a minimum bid of rate of 5.5% with an aggregate operation of limit of 500 billion. Conduct standing overnight reverse repo agreement operations at an offering rate of 5.3%, countering our per counterparty limit of 160 billion per day. Rollover at auction, the amount of the principal payment. I need to get more familiar with these terms. I'm not going to go over all of it. They did say something about mortgage-backed securities. Reinvest the amount of principal payments from the Federal Reserve's holdings of agency debt and agency mortgage-backed securities received in each calendar month that exceeds the cap of 35. Yeah, so I'll get more familiar with the terms. I don't think there's not a lot of signal I can give you from that. So I think we got the gist of it. I do think that they're starting to voice that they're going to ease quite a bit. I think that's great, and we're going to go ahead and let these guys talk here and finish what they're saying before the meeting.
So September can. At the
Let's
board,
get closer to the
I learned
end,
quickly that
what I wanted, at least, which is
go.
acknowledgement of risks in the labor market. The more I look at that, the more it's clear to me that they're going in September. If I were Mike McKee, a lot of people tried to press the Fed on what their neutral.
I'm fast forwarding a little bit just to make sure that we're getting right at the moment, so that we're there when he starts talking. But yeah, guys, I think we're set up good. We got less than a minute here. I think we're ready to rock. I'm probably going to, on another screen here, I'm going to take the map stock that I had and maybe broadcast it. Yeah, I'm going to broadcast it. I'm going to show you guys it. I'm going to do something different here. I'm going to go to default view. I'm going to go to stock 1, and I'm going to choose the stock heat map. I'll see if I can make this prettier. Let me see here. I don't know if that's probably as good as it gets. Let me see if I could just adjust. Nope, don't do that. Bad move. All right. So I'm going to have that in the bottom corner, and if it starts changing colors, you know what I should do? I can change the performance date and time to 1 hour, and here's Powell. Here we go.
Afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices.
Please hit the like button, guys, please.
For the benefit of the American people. Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance, and the unemployment rate remains low. Inflation has eased substantially from.
If you didn't catch it, you're going to see green or red in the bottom or the left-hand side now for the stock market heat map. So, and that's as of this last hour. So it should change pretty dramatically if he starts to say something positive or negative.
A peak of 7% to 2.5%. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. We are attentive to risks on both sides of our dual mandate, and I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a.
This is what I already said. We're really looking for the Q&A.
Down from 3.1% last year. Private domestic final purchases, or PDFP, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal of underlying demand, grew at a 2.6% pace over that same period, the first half. Growth of consumer spending has slowed from last year's robust pace, but remains solid. Investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment stalled in the second quarter after a strong rise in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 177,000 jobs per month in the second quarter, a solid pace, but below that seen in the first quarter. The unemployment rate has moved up, but remains low at 4.1%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years, and a strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggest that conditions in the labor market have returned to about where they stood on the eve of the pandemic, strong but not overheated. Inflation has eased notably over the past 2 years, but remains somewhat above our longer-run goal of 2%. Total PCE prices rose 2.5% over the 12 months ending in June. Excluding the volatile food and energy categories, core PCE prices rose 2.6%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As the labor market has cooled and inflation has declined, the risks to achieving our employment and inflation goals continue to move into better balance. Indeed, we're attentive to the risks to both sides of our dual mandate. We have stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. The second quarter's inflation readings have added to our confidence, and more good data would further strengthen that confidence. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we have seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the longer run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
I don't love this initial part. It seems like he's saying we're going to be late.
Gina Smilek from the New York
Let's see if he can clean that up in the Q&A.
Times. Thanks for taking our questions. Markets pretty much entirely expect a rate cut in September at this stage. I wonder if you think that's a reasonable expectation, and if so, why not just make the move today?
Thank you. So on September, let me say this. We have made no decisions about future meetings, and that includes the September meeting. The broad sense of the committee is that the economy is moving closer to the point at which it will be appropriate to reduce our policy rate. In that, we will be data dependent, but not data point dependent. So it will not be a question of responding specifically to one or two data releases. The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September. So you asked why not today, and I would just say, again, that the broad sense of the committee is that we're getting closer to the point at which it will be appropriate to reduce our policy rate, but that we're not quite at that point yet.
Howard.
So just to follow up on that a bit, if inflation behaves as you expect between now and September, would you regard a cut in September as sort of the baseline scenario right now?
So I guess I would think about it this way. I'll give an example of cases in which it would be appropriate to cut, and maybe that it wouldn't be appropriate to cut. So if we were to see, for example, inflation moving down quickly or more or less in line with expectations, growth remains, let's say, reasonably strong, and the labor market remains, consistent with its current condition, then I would think that a rate cut could be on the table at the September meeting. If inflation were to prove, stickier, and we were to see higher readings from inflation, disappointing readings, we would weigh that along with the other things. I think it's going to be not just any one thing. It's going to be.
It sounds like you just said they're going to cut rates in September.
The inflation data. It's going to be the employment data. It's going to be the balance of risks as we see it. It's going to be the totality of all of that help us make this decision.
And just to follow up on that, specifically, in what ways right now, given all you've seen over the last few months in particular on shelter, on services, et cetera, in what ways are you not confident right now that inflation is on the way back to 2%?
I think it's just a question of seeing more good data. We have seen the last couple of readings have certainly added to confidence, and we've seen progress across all three categories of core PCE inflation. That's goods, non-housing services, and housing services. So it's really just, we had a quarter of poor inflation data at the beginning of the year. Then we saw some more good inflation data. We had 7 months at the end of last year. We just want to see more and gain confidence. And as I said, we did gain confidence, and more good data would cause us to gain more confidence.
Colby.
Thank you. Colby Smith with the Financial Times. The March SEP pointed to 3 cuts in 2024 with core inflation at 2.6% and the unemployment rate at 4%. Since we're now at that level in terms of inflation and already beyond what was projected for the labor market, I'm just wondering if that rate path is back to being the best guidepost for policy rather than, let's say, the shallower one laid out in the June SEP.
So I would just say, really the path ahead is going to depend on the way the economy evolves. And I can't really give you any better forward guidance on it than that. We didn't, of course, do an SEP at this meeting. We will do another one at the September meeting. I would just say I can imagine a scenario in which there would be everywhere from 0 cuts to several cuts, depending on the way the economy evolves. And I wouldn't want to lay out a baseline path for you there today. I've said what I can say about September and about today, though.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've said before that you wouldn't wait until inflation.
This is Nikki Leaks, so he definitely has a lot to say. Listen to him.
Got to 2% to cut rates because of how inflation has lagged. Does that apply for the labor market too? If the labor market is back in equilibrium, why is restrictive policy and potentially very restrictive policy, given the high real funds rate, warranted right now?
So this is the very reason that we're thinking about.
This is what I want to know the answer to. I want to see how he words this.
That we've said in our statement that we're going back to looking at both mandates and that we think the risks are coming back into balance. We think what the data broadly show in the labor market is an ongoing gradual normal.
Bitcoin's going up, markets recovering, dollars dropping, 2 years starting to roll over again, and it looks like the inversion is we're not uninverting yet.
Of labor market conditions, and that's what we want to see. We've seen that over a period of a couple of years, and a move really from overheated conditions to more normal conditions. We are watching the labor market conditions quite closely, and that's what we're seeing. If we start to see something that looks to be more than that, then we're well positioned to respond. That's part of what we're thinking.
And when you talk about seeing something that's more than whatever softness or slowdown you expect, in the past, you've said that stronger growth wouldn't override better news on inflation. I wonder how that cuts the other way. If you're seeing more softness in the labor market than what you would expect, does that change the calculus on what you're looking for out of the inflation numbers to recalibrate policy?
So we have growth isn't one of our three. We have two mandates, as you know. The labor market, maximum employment is one, stable prices is another. So we weigh those two things equally under the law. When we were far away from our inflation mandate, we had to focus on that. Now we're back to a closer to even focus. So we'll be looking at labor market conditions and asking whether we're getting what we're seeing. And as I said, we're prepared to respond if we see it that it's not what we wanted to see, which was a gradual normalization of conditions. If we see more.
So if the labor market starts blowing up and we start to see a lot of jobs, they're not going to cut in September. But that would be a good scenario for the markets. And then if the labor market does continue to weaken or look soft, they're going to cut, which would be good for the market, at least short term. Both these things are good.
Than that, and it wouldn't be any one statistic. Although, of course, the unemployment rate is generally thought to be, a good single statistic. But we'd be looking at wages, we'd be looking at participation, we'd be looking at all the things, surveys, quits, hires, all of those things to determine the overall status of the labor market. But we're looking at it now. I would say again, I think you're back to conditions that are close to 2019 conditions, and that was not an inflationary economy. Broadly similar labor markets then. I think inflation was actually.
Did he just say what 2019 before the pandemic? Okay.
Actually, core inflation is actually running below 2%. So I don't now think of the.
I actually think we're closer to the 2000s or the 90s personally, like early 2000s.
Labor market in its current state as a likely source of significant inflationary pressures. So I would not like to see material further cooling in the labor market, and that's part of what's behind our thinking. The other part, of course, is that we have made real progress on inflation, and we've got growing confidence there that we are not quite there yet, but we're getting more confident that we're on a sustainable path down to 2%. So those two things are working together, and we're factoring those both into our policy.
Chris.
Chris Rugaber, Associated Press. You mentioned not wanting to see any further cooling in the job market. Why not, or would you consider preemptive cuts to prevent if you saw?
All right, real quick, guys. So I think we're cutting rates in September. We're going to continue to listen to them. I did want to say, if anybody's wondering why I kept talking about TNA, this 3X 20-year fund, it was because of this. It's up 2% on the day. It looks like it's heading into a breakout zone. So again, this is the time where people start to jump into this to lock in rates, or just because they think it's going up. They think they're going to make money off this fund.
All risks of an unexpected cooling. Is that something you would cut ahead of time for?
So I wouldn't say I wouldn't want to see any other cooling. It would be more of a material difference. If we'd be looking at this, and if we see something that looks like a more significant downturn, that would be something that we would have the intention of responding to. So in terms of, I don't think of it that way. I think of it as, we're actually in a good place here. We're balancing these two risks of, go too soon and you undermine progress on inflation, wait too long or don't go fast enough, and you put at risk the recovery. And so we have to balance those two things. That's the nature of having two mandates. And I think this is how we balance them. It's a rough balance, but it does feel like, again, the labor market feels like it's in a place where it's just a process of ongoing normalization. Every market seems to be loving this right now. 1% unemployment is still historically low. And we'll just have to see what the data show us.
And just to follow quickly, wanted to see what you thought of the recent JOLTS report, which did show gross hiring has come down even below 2019 levels. Layoffs remain low, so it painted a picture of a very static labor market. Is that sustainable in your view, or something that is worrying? Thank you.
So I think all of the data points continue to point to kind of the direction we would want to see. So that was taken as there was a decline in job openings. That was good. Today's ECI reading was a little softer than expected, so that's a good reading. It shows that wage increases are still at a strong level, but that level continues to come down to more sustainable levels over time. That's exactly the pattern that we want to be seeing. So I think the data we've been seeing in the labor market are broadly consistent with that normalization process. Again, we're closely monitoring to see whether it starts to show signs that it's more than that.
Steve Leisman, CNBC. Mr. Chairman, back in March, you talked about cutting rates as a process, and in June, you talked about the idea that, well, one rate cut wouldn't do anything. So I wonder if you can sort of follow up on Colby's question, talk about, are you weighing the economy right now in terms of its ability to withstand multiple rate cuts? Talk us through the process that you're thinking, or is it just one rate cut? Or are you in the process now thinking that rates need to be normalized here? Thank you.
Yeah, I can't really say that, honestly. We've seen significant movement in the labor market, and we're very mindful of this question of is it just normalization or is it more? We think it's just more normalization, but we want to be in a position to support the labor market. At the same time, we're seeing progress on inflation. So we actually got to this. We raised rates a year ago at the July meeting, and if you look at the situation in the economy a year ago, inflation was over 4%. It was a completely different economy. Now we've made a lot of progress, and the labor market has, I think, unemployment was in the mid threes. So it's a different economy, and I think it's coming to be time to adjust that so that we support this continued process. The thing we're trying to do is, that we have, we've had this really significant decline in inflation, and unemployment has remained low. And this is a really unusual and historically unusual and such a welcome outcome for the people we serve. What we're thinking about all the time is how do we keep this going? And this is part of that. We think we don't need to be 100% focused on inflation because of the progress we've made. 12-month headline at 2.5, core at 2.6. It's way down from where it was. The job is not done on inflation, but nonetheless, we can afford to begin to dial back the restriction in our policy rate. And I think we're just as part of a process. In terms of what that looks like, I think most you would think in a base case that policy rates would move down from here, but I don't want to try to give specific, forward guidance about when that might be because the pace at which it.
He doesn't think he knows they're going to go down from here. Again, we have to try and balance our 1.17 trillion in interest on debts.
Might happen because I think that's really going to depend on the economy, and that's highly uncertain.
Rachel. Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. On inflation, do the past few months of good reports look like what we saw last year, where you really had a lot of momentum with a few bumps in between? Would you characterize that kind of momentum as back on track at this point in the year?
Actually, what we're seeing now is a little better than what we saw last year. Last year, as we pointed out late in the year, a whole lot of the progress we saw last year was from goods prices, which were going down at an unsustainable rate, disinflating at an unsustainable rate. This is a broader disinflation. This has goods prices coming down, but we're also now seeing progress in the other two big categories, non-housing services and housing services. So, so the thing is you got 1/4 of that. We had 7 months of low inflation. You got 1/4 of this. I would say the quality of this is higher, and it's good, but so far it's only a quarter. So I think we need to see more to know that we're, to have more confidence that we're on a good path down to 2%. But as I mentioned, our confidence is growing because we've been getting good data. Okay. And things like the ECI report and, frankly, the softening in the labor market conditions, give you more confidence that the economy's not overheating. It doesn't look like an overheating economy. And it looks like an economy that's normalizing.
Okay. And if we were to think about the first couple of months of the year, is there any sense now that they were these blips that could have actually allowed for earlier rate cuts, as were some of the projections going into 2024?
So the thing about if what it is seasonality, and it could just be, it's very, very hard to do appropriate seasonal adjustments. If that's what it is, then that actually implies that other months we're under-reporting too low inflation. If you smooth it out, it's a zero-sum game. And that's why we look at 12 months. We look at 12 months because that takes all that out, all those effects out. 12-month now is 2.5% headline, 2.6% core. This is so much better than where we were even a year ago. It's a lot better. Now, the job is not done. I want to stress that, and we're committed to getting inflation sustainably down to 2%, but we need to take note of that progress, and we need to weigh the risks to the labor market and the risks to our inflation target now more equally than we did a year ago.
Michael McKee from Bloomberg Radio and Television. I'd like to ask you about the balance of risks as the American people see it. At this point, is the risk greater to leave interest rates where they are, given the damage that higher interest rates do to the economy in slowing demand and raising prices? Or is it more important for the American people that you keep rates where they are to bring inflation down?
I think that we've been given an assignment by Congress. This is how we serve the American people, is by achieving maximum employment and price stability, right? And so in our, quasi-constitutional document, the Statement on Longer Run Goals and Monetary Policy Strategy, we look at the two goals, and if one of them is farther away than the other, the two variables, inflation and employment, if one is farther away from its goal than the other, then you concentrate on the one that's farther away, and you take account of the time to reach the goal. So for the last couple of years, the best service we could do to the American people was to focus on inflation. But as inflation has come down, and I think the upside risks to inflation have decreased as the labor market has cooled off, and labor market has softened, probably the inflation is probably a little farther from its target than is the employment, but I think the downside risks to the employment mandate are real now. So we have to weigh all that. And if you think about where that takes us, is we have a restrictive policy rate. It's clearly restrictive. It's been the rate we've had in place for a full year. And the time is coming, as other central banks around the world are facing the same question, the time is coming at which it will begin to be appropriate to dial back that level of restrictions so that we may address both mandates.
Well, you have event risk, basically, with the jobs report on Friday and another one before you meet again. Are you certain that you won't fall behind the curve and lead to unnecessary unemployment if you wait until September?
Very important question. Very important how he answers this.
Certainty is not a word that we have in our business. We get a lot of data between now and September, and it isn't going to be one data read or even two. It's going to be the totality of the data, all of the data, and not just and then how is that affecting the outlook and how is it affecting the balance of risks? That's going to be the assessment that we do. Of course, we'll all look carefully at the employment report, but so much other data coming in, and so much happening between now and the September meeting, and we'll make a judgment.
Edward.
Thank you, Mr. Chairman. Edward Lawrence of Fox Business. I do want to dig deeper on what Michael and what Nick were asking. There's a shift in the statement to balance between the focus between inflation and jobs. Looking at the job sides, we've seen wage data show sort of an abrupt slowing. We're hearing on earnings calls from companies like Intel abrupt layoffs. In the jobs report from the BLS, government jobs has been a leading creator. Could the government jobs as a sector hiring mask underlying weakness in the jobs report?
Well, we'll look at everything. We've seen some tendency to have a narrowing base of job creation in some months going back, but then we've had some months where job creation was broader, and also the headline number of jobs has come down. So but you look at the whole thing, and I think you do look at private demand extra carefully. To your point about government. So we'll just be looking at all those things.
So as a follow then, so could the Fed then be behind the curve? Because you said some of the reports, last meeting, you said the reports could be noisy or overstated. Was there a discussion of what kind of discussion was there for a cut today? And could the Fed be behind the curve?
Yeah, so look, the objective is to balance the two risks, right? It's the risk of going too soon and the risk of going too late. We've been, We had 7 months of good inflation data at the end of last year. We said we wanted to see more. We pointed out that too much of this was coming from goods, and sure enough, the first quarter wasn't great inflation data. Now we've got a quarter that is good, and we're balancing the risk of going too soon against the risk of going too late. That's what we're doing. There's no guarantee in this. It's a very difficult judgment call, but this is how we're making it. But in terms of today, your question about today, we did have a nice conversation about this issue today. The overall sense of the committee, as I mentioned, is that we're getting closer to the point at which it'll be appropriate to begin to dial back restriction, but we're not quite at that point yet. We want to see more good data. The decision was unanimous. All 19 participants supported it. But there was a real discussion back and forth of what the case would be for moving at this meeting. A strong majority supported not moving at this meeting. That was the strong sense of the committee. But it's a conversation that we had today, certainly.
Courtney. Courtney Brown from Axios. Thank you for taking our questions. When the Fed was raising rates, there was a lot of conversation about long and variable lags. I wonder if that applies on the way down too. How are you and the committee thinking about that?
Yes, it does. And I think the lags have kind of showed up here in the last 6 months, by the way. You really do now see the restriction, whereas, even a few months ago, people were questioning how restrictive policy was. Look at the labor market now. You can see, and look at inflation, rate-sensitive, interest-sensitive spending. You really do see now that policy is restrictive. I wouldn't say it's extremely restrictive, but it's certainly effectively restrictive. Yes, the lag should be on the way down. It should take some time to get into the full economy, affect financial conditions, and that affects economic activity, hiring, and that kind of thing, and ultimately inflation. It's not instantaneous, although it's faster than it used to be because markets move now in anticipation of our moves.
So are you worried then that if monetary policy acts with long and variable lags, even when you're lowering interest rates, it might be too late for the Fed to help stave off any kind of slowdown in the labor market or broader economy?
Yeah, we have to worry about that. Just to make it clear, it's a very difficult, challenging judgment, and we don't want to go too soon. We don't want to go too late. But this is how we've made that judgment. I feel good about where we are. We're certainly very well positioned to respond to weakness with the policy rate at 5.3%. We certainly have a lot of room to respond if we were to see weakness. That's not what we're seeing, though. What we're seeing, look at the first half growth numbers. Look at PDFP at 2.6% for the first half. It's not signaling a weak economy. It's also not signaling an overheating economy. Labor market, admittedly, the unemployment rate has moved up 0.7, and we're seeing a normalization there. But wage increases are still at a high level. Unemployment.
If you look at the markets in the bottom left corner here, or in the bottom left or the middle left of the screen, you'll see they're all doing well. NVIDIA's up 1.45% just on this since in the last hour.
It's still at a low level. Layoffs are very low. Initial claims have moved up, but they're pretty stable, and they're historically not high at all. So the total scope of the data suggests a normalizing labor market. And again, we are carefully watching to see that continues to be the case.
Victoria.
Hi, Victoria Guido with Politico. On the labor market, I was wondering, how worried are you all about unemployment rising to the point where it triggers the SOM rule? And would that potentially affect how quickly you cut rates?
So I would just say the question really is one of, are we worried about a sharper downturn in the labor market? So, and the answer is we're watching really carefully for that. We're aware of that rule, which is really I would call it a statistical thing that has happened through history. A statistical regularity is what I'd call it. It's not like an economic rule where it's telling you something must happen. So again, what do we see? What are our eyes telling us? We look at all the things we're seeing, and what it looks like is a normalizing labor market. Again, job creation at a pretty decent level, wages moving up at a strong level, but coming down gradually. Job vacancies have come down, but they're still high by historical standards. So again, I've been through some of the data already, but what we think we're seeing is is a normalizing labor market. And we're watching carefully to see if it turns out to be more, if it starts to show signs that it's more than that, then we're well positioned to respond.
Is there reason to think that the labor market might behave differently this time than it has historically?
I think, history doesn't repeat itself. It rhymes. I think that statement is very true about the economy. You never assume it's going to be just the same. An example would be, is there a trend increase in the level of vacancies? There are many, many examples, so it's never exactly the same. Also, let's remember that this pandemic era has been one in which so many, apparent rules have been flouted, like the inverted yield curve, for starters. So many pieces of received wisdom just haven't worked, and it's because the situation really is unusual or unique in that so much of this inflation came from the shutdown in the economy and the resulting supply problems in the face of, admittedly, very strong demand. So the whole situation is not the same as many of the other prior inflation or downturns that we've seen, or business cycles that we've seen. So we're having to learn, we're having to, to be very careful about the judgments that we make, I would say. So we don't assume that these regularities will just repeat themselves automatically.
That's smart.
Thank you, Chair Powell. I'm Mara Mokwe with Bloomberg. There seems to be quite a difference between what the anecdotal data are telling
Please hit the like if you would. Please support my work.
Us, such as the very recent downbeat beige book and the hard data. Do you take those anecdotes seriously? That is, that the economy and labor market are cooling much more rapidly than what's shown in the data?
So I do take that seriously, and the beige book is great. What's even greater is hearing the Reserve Bank presidents come in and talk about their conversations with businesses and business leaders and workers and people in the non-profit sector in their districts. But I'll tell you, it's a pretty, the picture is not one of a slowing or, a really bad economy. It's one of there are spots of weakness.
ARCG is now at 4.5%. That's pretty awesome.
And there are regions where growth is stronger than other regions. But overall, it's, again, look at the aggregate data. Aggregate data is, particularly PDFP, private domestic final purchases, is 2.6%. And that's a good indicator of private demand. So we listen to all of that, and it does. I think it's important to listen to anecdotal data and not just look at the aggregate data. Especially, it's very hard. GDP data can be volatile quarter to quarter, so it's just hard to measure economic activity. There are it's just difficult to do. So I look at both, but I wouldn't say that the anecdotal data is uniformly downbeat. It's more mixed.
Thank you. Jolene Kent with CBS News. Chair Powell, thanks for taking our questions today. You have consistently said that the Fed does not consider politics in making decisions. With a possible September rate cut on the table, it would be less than 2 months before the election, and former President Trump reportedly said that cutting rates so close to the election is something the central bank knows they shouldn't be doing. What's your response, and do you believe it's possible to really remain apolitical with a September rate cut?
I absolutely do, and I think it's, first of all, we haven't made any decisions. I would say it this way. Haven't made any decision about any future meeting. I don't know what the data will reveal or how that will affect the appropriate path of our policy. I really don't know. I do know how we will make that assessment. That's what I do know. So if you take a step back, the current situation, again, is inflation has come down much closer to our goal, and that's happened while unemployment has remained low. We're very tightly focused on using our tools to try to foster that state of affairs continuing. That's at each of our meetings and all of our decisions, our focus is strictly on that and really on nothing else, doing our part, whatever that part may be. We're using our best thinking. We're doing our best to understand the economy. We follow academics. We follow the many commentators who bless us with their commentary. But we don't change anything in our approach to address other factors like the political calendar. Congress has, we believe, ordered us to conduct our business in a non-political way at all times, not just some of the time. I'll say this too. We never use our tools to support or oppose a political party, a politician, or any political outcome. The bottom line is, if we do our very best to do our part and we stick to our part, that will benefit all Americans. If we get it right.
I actually think Powell is saying the truth when he talks about not being political. I don't know that that same thing translates over to the Treasury, but I think it definitely is that way from the Fed.
The economy will be stronger, we'll have price stability, people will find jobs, wages will rise in real terms, everyone will benefit. So that's what we believe, and that's how we will always act. This is my 4th presidential election at the Fed. I can tell you this is how we think about it. This is what we do. So anything that we do before, during, or after the election will be based on the data, the outlook, and the balance of risks, and not on anything else.
Just a quick follow-up. Do your economic forecasts and models take into account the two very different economic plans of these two presidential candidates, Harris and Trump? And if so, how?
No, we do not do that. We absolutely do not do that. We don't know who's going to win. We don't know what they're going to do. We don't act as though we know, and we just can't do that. We basically have our forecast. We can run simulations of different potential policies, but we would never try to make policy decisions based on the outcome of an election that hasn't happened.
And when I say I think the Fed isn't political, I'm actually just referring to Powell. Previous Feds, I can't say that.
Yeah, that would just be a line we would never cross. We're a non-political agency. We don't want to be involved in politics in any way, so we wouldn't do that.
Nicholas.
Thank you, Chair Powell. Nicholas Jasinski from Barron's Magazine. There hasn't been a dissenting vote on an interest rate decision in some time. If the data do evolve as you expect, if you do have more confidence by the September meeting, do you get the sense that there will be a unanimous vote on an interest rate move in September? Or basically, are there meaningful differences in committee members' assessments of how much more confidence is needed?
So there are always meaningful differences. There are, and we talk a lot before, during, and after the meeting. We do have a very robust discussion of these things. You're right that in most cases, people, if they feel heard and they feel that their position has been given serious consideration, for most people, most of the time, that's going to be enough. There are dissents. That's fine. No one has a veto. No single person has a veto. So it just is a question of who will vote for and against. We've had dissents. We haven't had so many during the pandemic era, and it just may be that we've felt more united because we felt under a lot of pressure to get things right. But before the pandemic, we had plenty of dissents, and dissents happen. It's part of the process. There's nothing wrong with dissents, and if it happens, it happens.
Jean.
Hello, Jean Young with MNI Market News. Is a 50 basis point cut as a first cut at all likely or even on the table? Thank you.
I don't want to say, I don't want to be really specific about what we're going to do, but that's not something we're thinking about right now.
Jennifer.
Of course, I haven't made any decisions at all as of today.
Thank you, Chair Bell. Jennifer Schonberger with Yahoo Finance. Not to get into the minutes, but you said there was a real discussion today for moving at this meeting. I'm curious if you could provide some more color on the nature of the discussion today at the meeting about a possible rate cut as early as September.
Well, so, the way the meeting is set up, the first day there's a discussion of financial stability because it's every other meeting we have that. And then we have an opportunity to comment on that. Then we have an economic go-around. And then this morning we have the monetary policy go-around. And I think in people's economic go-around and in their monetary policy go-around, people express their views about this. And there's a range of views. People, as you will know from the speeches that they give, people have different ways of thinking about the economy. And so in the minutes, we'll lay this out in a much better way than I can do off the cuff. But there's a range of perspectives, and but I do think that we're a consensus-driven organization. People come together. This was a unanimous decision, and at the end, everyone supported the outcome, not just the voters, but everyone. So I would also say some people examine the possibility, the case for moving at this meeting, but overwhelmingly the sense of the committee was not at this meeting, but as soon as the next meeting, depending on how the data come in.
But there is a growing sense of confidence that you could move at the next meeting, assuming
Yes.
inflation comes.
Well, assuming that the totality of the data supports such an outcome, no question. That is the case. That, as I mentioned, we think that the time it's approaching, and if we do get the data that we hope we get, then a reduction in our policy rate could be on the table at the September meeting.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Former New York President Bill Dudley wrote an op-ed in Bloomberg earlier this month, which you probably saw, in which he said, quote, "It might already be too late to fend off a recession by cutting rates. Dawdling now unnecessarily increases the risk." Is he wrong?
So this is the judgment that we have to make, and we're well aware of the judgment. We're as I've said, we have to weigh the risk of going too soon against the risk of going too late. If we go too soon, we can, we had a lot of advice, to go ahead and cut after the 7 good months of last year. We didn't. We said we needed to see more. Then we saw some higher inflation. We've seen 1 quarter of good inflation, and we've seen the labor market move quite a bit. And as I mentioned, I don't think it needs to, cool off any more for us to get the inflation results that are related to the labor market. Not all inflation is, of course. So I think it's a difficult judgment to make, and what you see is the judgment of the committee is that that time is drawing near. That time could be in September, if the data support that.
And have the chances of a hard landing increased?
Ooh. So I don't know whether they've increased. I think they're low. I think this is, you don't see any reason to think that this economy is
Thanks for joining, Kabank.
Either overheating or sharply weakening. That's just not in the data right now. What's in the data right now is an economy that's growing at a solid pace, a labor market that has cooled off, but nonetheless, unemployment is low. The data overall show a strong labor market. So that's really what you see. It's neither an overheating economy nor is it a sharply weakening economy. It's kind of what you would want to see, but of course, the job is never done. We're watching to see, which way the economy heads, and I think if we are to respond to weakness, we're certainly, well equipped to do that. But that's not what we're seeing. What we're seeing is strong economic activity and a good labor market and inflation coming down.
Greg.
Thank you so much. In the minutes of the June meeting that came out a few weeks ago, there was a discussion about communications, and some Fed officials said maybe the Fed wasn't as clear enough about its reaction function. And when I talk to the commentators who bless you with their comments, they say that they really don't have a sense of what is going to judge, maybe not the first cut, but the pace of the cuts going forward. They don't have a good sense of that. Is there anything you can say, like, how will we judge that?
I think the reality is that forecasters, and this isn't just the Fed by any means, forecasters have been continually surprised by, for example, the strength of the economy last year. So I think we have to be pretty humble about giving forward guidance about this, that, and the other thing. We need to be pretty careful about that. And when you're saying you're going to be data-driven, of course, it's always what the data, how they affect the outlook and the balance of risks. But nobody has great vision deep into the future. In terms of a reaction function, that's a long time discussion that people have had forever. I think people have understood for a long time actually that we were very focused on bringing down inflation. Nobody was really confused about that. The data have, again, you've seen significant improvement in inflation just for the last quarter. Markets move around on the data really, not so much. It's not really what we're going to do. It's more just that the data keep coming in, and markets are very, very responsive to that data right now.
Go to Jeff for the last question.
Thank you, Mr. Chairman. I'm going to change gears on you just a little bit from all of the rate talk and whatnot. With Fed now being in the books for a little over a year, there hasn't been a whole lot of talk about central bank digital currency, and wondering if you could give us an update on where things are with that. Is that considered a dead issue now? Is it still something that's being discussed within the committee, and what's happening with that?
It's not something that comes up at all in the FOMC. So more broadly, digital finance is an area that has really significant implications for payments generally, instant payments, and it's something that's going to really change the way it's going to make more efficient and hopefully safer and all those things the way payments are made around the world. And so we have people who are researching that and trying to keep up to speed because we play an important role in the payments sector, both as a convener and as an operator too. In terms of a CBDC, there's really nothing new going on. There's not much going on at all. We don't have the authority to issue a retail CBDC that's available to the public. We're not seeking that authority. So what we're doing is keeping up with developments there. Pretty much every major central bank in the world is at least doing that. Some of them are actually seriously looking at implementing a CBDC. We're really not. We're really just evaluating, the story and what's happening out there. I think it's work that we need to be doing which could be very beneficial down the road. But we don't have on a CBDC. We don't have any plan. We would need to go to Congress, and we have no plan to do that. No one here has decided that we think it's a good idea yet. Thank you.
That wraps up the July Federal Reserve News Conference with Chairman Powell. If you are just tuning in,
I'm not going to lie. I actually think that went pretty smoothly. I don't know what the market's going to do over the next couple of minutes. I will probably, let's see here, stock market heat map shows NVIDIA still doing well. Let's look at the dollar. So NVIDIA's 1.37%. That was kind of the high of the speech. Note, I only have this as a performance of the last 1 hour. So this is kind of what people thought of the meeting in regard to these stock prices, right? And then if we look over here, we can see the dollar is continuing to roll over. I actually love that. I believe the dollar will probably do something like this, maybe even for the coming months. Did I buy TLT? I bought TMF. It's a 3x play for the TLT. So I have about, let me see how much I have. I have about $70,000 in TMF. It's up about 4% from where I bought it about 36 hours ago. So it's a nice little hedge. I'm probably going to add to it as markets scream higher. I'm probably going to continue to buy more, especially if I get some down days on it. So I might be doing some like selling of some of the things that make me a lot of money. Here's what I got though, guys. So again, dollars rolling over. Let's just go over this real quick. The inversion hasn't done much of anything. It's still kind of trading sideways. I think it could do that for a while. Maybe in September we start to uninvert. It doesn't mean the markets crash right away. The 2-year is doing what I talked about it doing, which is what we loved, right? It's rolling over. It's rolling over out of this wedge. And again, I think there's a distinct possibility that we drop even to the 3% range in the months ahead. So I think you're going to see a dramatic rollover in the months and quarters ahead, which is great. That's what we want to see. And then let me see what else here. So again, just rolling through this. And here's Bitcoin. Let's look at Bitcoin. Bitcoin's a great barometer for markets over the short term. It is breaking down from some of this news. It's starting to drop. Let's see if it continues. Wouldn't be crazy. This is kind of a bear flag. Wouldn't be crazy to see some breakdown to the 65,000s a little bit lower. I actually hope it does. I think that's great. But also beware. On at least the 30-minute, you can see where this is pushing it down. If it doesn't push it down, it will break up. But yeah, if we look at the hour, let me get this stupid thing off here that I put on. If we look at the hour, this does look like a bear flag. So we could see downward pressure. I think that's totally possible, trying to break through the 65 line. That seems possible for Bitcoin just from a technical standpoint. I actually think what we heard a little bit ago was great. But let's look at other stuff and see how it's doing. Let's look at that TMF, that 3X fund I was talking about. So it's only up 2.21% now. You can see where it was a little bit higher in the meeting. So it started to retrace a little bit. Let's look at ARKG. ARKG was up almost 4% in the meeting. It is only up 3% right now. So we retraced a little bit. Here's the deal. I think the path is up. It doesn't have to happen right away. PayPal's still looking strong, probably runs, I think, no matter what. I bought TNA January 2026 calls 2 weeks ago. See, I get a little weary on the calls just because I don't know if I can pick the right time frame on them because these things move so slow with the bond market. Only recently has the bond market just went insane, right? Like the bond market now is crazy compared to what it normally is. This 2-year, even if we just pull up TLT, and you know what? Let me just pull up TMF. Actually, let's go back. Where is it? It's in here somewhere. PayPal. Right here. So if we just look at this and go over a longer time frame, this thing, the bond market here is crazy. So again, this is TMF. This is like an extended fund. Let me get some of this shit off of here. There we go. So if you look here, though, the path for the TMF going back to 2008, this is just TMF. Let me pull up TLT, see if I have that, because that's a much cleaner chart. Because this is a 3X fund, it's probably not a fair comparison. But yeah, if you go back further, if you go back to the 2003, 2002 range, right, and you look at this, look at the catastrophic drop on the TLT. It literally was dropped by like 60% plus. So that is catastrophic for bonds. Worst route in 200 years, depending upon what you're looking at. So Huma is up 17%. I don't know what that is, JCV. But so guys, I'm probably going to cut this stream in a little bit here. I'm very positive about what Powell had to say. I think basically he set it up for cuts in September. I don't know how the market's going to digest it over the next 44 minutes or something like that, or 38 minutes. But I think the general direction's up. I 100% agree with Tom Lee. That's what's coming. So if you haven't already, you totally should have been buying the dip. And if you haven't been doing that, I would be doing that right now because I don't think Bitcoin's going to zero. I actually think we're going to be pumping, and I think we're going to be hearing a little bit of this in the future. So again, I'll see you guys in about 30 minutes on the market recap. Going to have a lot of good stuff to cover in that too. I think we'll skip over and just maybe briefly highlight some of the Fed stuff, but we'll focus on other investments and looking at your stock picks today. So if you guys want, get in there. Again, I'm going to be gone Thursday, Friday, Saturday, traveling with family and my kid and one of our friends and wife. So I won't be around. I'll probably try and be back Sunday though for a little pregame of Monday. So if you can make the market recap, I think it'll benefit you. Otherwise though, let's just play this because this is what's coming.
Well, you know what time it is.
Love you guys.
We back,
see you in a bit.
baby. Bitcoins, shitcoins, or NFTs. There's no greater feeling than hitting that sweet. Old time high in this bitch. Watch it pump to the sky. We just buy and get rich. Old time high in this bitch. Watch it pump, baby. We just buy and get rich. Run it back. We back in the black. We back in the green. Got the team all around me. We rowdy and causing scenes. Where you been? Grab a cup, baby. Come and take a sip. Oh my bad, yo, what's up? Man, you didn't buy the dip. Oh, that's rough. Oh, that's tough. Oh, that's really gotta suck. Only problem that we got is that we didn't buy enough. Man, I joke. Man, I kid. Know exactly what we did. Now we pull up in the whip. Cause we just hit. Old time high in this bitch. Watch it pump to the sky. We just buy and get rich. Old time high in this bitch. Watch it pump, baby. We just buy and get rich. Got my family on the phone, they asking what they should buy. I say a time machine to take you back to when I was trying to get you buying on the low instead you trying to buy high. I guess it's time for me to sell this shit and wave it goodbye. Like sayonara, I don't wanna be stuck there with the bag. Don't be mad, I'm just saying I'm taking some of the cash that we stacked up, baby, cause we out of here. As we blast up straight into the stratosphere. Right through the old time high in this bitch. Watch it pump to the sky, we just buy and get rich. Old time high in this bitch. Watch it pump, baby, we just buy and get rich. time high in this bitch. Watch it pump, pump, baby. We just buy and get rich. Once again.
Peace, guys. See you in a bit.